All right, good afternoon, everybody. Thank you for joining us on the second quarter 2021 Market Intelligence Reports released from Logic Analytics Research and Consulting, or LARC. For those of you that don't know me, my name is Ryan Melliker. I'm president and co-founder of LARC. We're going to jump into a slide deck here, and at the end, we're going to leave time for Q&A. But before we get started, I want to just highlight a couple of things for everybody. First and foremost, this webinar is being recorded. So if you don't want to be recorded, you can hop off. We will have it posted on our website, www.larcanalytics. That's LARC, like in the middle of your screen right now, larcanalytics.com. Hopefully later today, but certainly at latest tomorrow, this will get posted. A couple other things, there will be a Q&A session at the end of the presentation. So if you have questions, you can feel free to throw them into the Q&A option within the Zoom window. And we'll start to go through those at the end of the presentation. If we don't get to your question, we'll try to follow up with you afterwards, or you can certainly email us at information@larcanalytics.com. And then the last thing that I'd mention is that when you exit out of your Zoom, you're going to be asked to take a survey. The survey is literally 4 multiple choice questions. It's taking me longer to describe the survey than for you to actually complete it. Please just complete the survey. It helps us understand how LARC might be able to help you or not help you going forward. And then we'll send out the slide deck to everybody that completes the survey. With that being said, I'm going to go ahead and dig in. So we're going to get started. This is the agenda for the webinar. For those of you that have been on our past quarterly webinars, this should look pretty familiar. It's very similar. We're going to walk through briefly our approach to market intelligence, followed by an overview of where the U.S. hotel market is, and then how this recovery is going to be a little bit different than past recoveries, our current U.S. outlook, and then some major market highlights, followed by the Q&A session. Now, one of the reasons we like to talk about our approach, and it's only a couple slides I want to go through here, is because we want you to understand where we're coming from. We don't just want to give you a forecast and say, hey, you should trust us. We want you to have confidence in the forecast. I think unfortunately, a lot of the challenges that we find out there is that we've got these prognosticators and forecasters out there, whether they be in-house or third party, and nobody trusts them because we don't know how they got to their numbers, and doesn't make a lot of sense. So we want you to understand how we get there, and hopefully that will help you have confidence that our numbers are as accurate as possible today. So that being said, the LARC approach is basically everything to analyze a market in one place. We look at things from all aspects that can drive things, that can drive the hotel market. And if you think about a typical LARC market intelligence report, it's going to include all of this information: the historical operating results, the detailed economic forecasting data, citywide pacing data, air traffic, the office market, supply outlook, short-term rentals, recent transactions, as well as key capital projects. When we talk about key capital projects, I refer to things that are both public and private. Public would be things along the lines of a convention center expansion or airport expansion. Private would be something along the lines of Hudson Yards office development or Centennial Yards. And those types of projects can either move demand from submarket to submarket across a major market, or can really shift the major market entirely and have a big impact. So it's just worth highlighting some of those things. Our forecasts are more than just the top line. We don't just provide supply, demand, OCADR, RevPAR. We look at items like wages, and we'll walk through US wages today. And again, wages are obviously a hot topic these days. Property taxes, hotel EBITDA margins, cap rates, and hotel values. So you get a good sense of where everything's going, because at the end of the day, RevPAR might matter a lot, but it's not the only thing that matters, right? Now, our approach is one of transparency. We want you to understand where we're coming from. As a client of other third-party forecasters in the past, I got incredibly frustrated by, we get this data point and we were told, well, it's a black box. The forecast is a black box. And that doesn't help me, because if the forecast is wrong and it's a black box, then it serves zero value. Forecasts are never going to be perfect, never going to be 100% accurate. We want them to be as accurate as possible, with as transparent as possible, in case there's factors that may shift, and you can understand why the forecast is off, and that way you can adjust it as appropriate in a real-time basis. which is exactly what we try to share with our clients. Our work is also market-based. We don't take a one-size-fits-all approach to forecasting, especially at the market level. We understand that there are different drivers of markets in New York versus Houston versus San Francisco versus Seattle versus Denver versus Myrtle Beach versus Houston, Dallas, et cetera. And because of that, we build out unique differentiated models across each market. And one of the reasons that I partnered with my partners, Evan Weiss and Dan Lesser, when we launched LARC was because between the three of us, we have valued hotels across every market around the country. We understand the drivers of markets. We know which markets are leisure oriented, which ones are corporate oriented, which ones are group oriented. We know if they're leisure, is it domestic or is it international? Is it drive to? What are the feeder markets? All those things that can impact a market. On the corporate side, is it financial services oriented or pharma or IT or professional and business services? And if it's one of those, is there a particular driver? If it's pharma, is it Merck driving it? Is it J&J, et cetera? Are there certain companies that really stand out? Understanding those nuances can be particularly helpful when you're building out statistical analytical models. And the last thing that I'd say is that our work is done based on what we refer to as a level of realism. Our forecasts are intended to be the most likely outcome. It is not the only outcome that's possible. It is the most likely outcome based on the information that we know at the time of the release, which is early June for these reports. The current market environment and impacts that, as does the outlook for the drivers of our models. We do not adjust our models. The data says what the data says. We don't believe in subjectively altering our models based on our gut feelings. So we'd rather have you do that. Our approach is we tell you what the data says, and then you can tell me why the data is wrong or why you think the data should be different. But I think when you mold the two together and you blend the science and the art, you don't know which is which. We'd rather provide the science and let you provide the art, and that's our approach. We do very simple. Those of you that have taken the Stats 101 class understand what this slide says, which is multivariable linear regression forecasting. That's what we're doing. It's not rocket science. Where our value comes in is we understand how to do this, coupled with understanding the markets. And you put those two together, and it's a recipe for highly accurate, deeply analytical forecasting. And like I said before, we don't make subjective adjustments. If there's a Super Bowl coming, we build it into the model. If there was a Super Bowl that was already there, we build it into the model. Same thing with the college football championship or Final Four or hurricanes. All those types of things can be built into the models, and we do that. Obviously, we can't forecast hurricanes, but we can build in the historical ones, know what the impact is when they do come. And then last thing that I would say before we dig into the next section is better data in equals better data out. We are focused on getting the best possible data possible out there for our work. So we use STR for historical operating results. Obviously, we think they're the best, certainly the best on the top line perspective and on the bottom line as well. We think they do great work. They have the biggest data set in terms of number of hotels and the longest history of data. Unfortunately, when you're using data sets that are short, that haven't been around for 20 years or longer, the data is incomplete, and you can't build data models with data that doesn't incorporate multiple downturns in it. Fortunately, STRs does, and we use that. We use economic forecasting from Moody's Analytics, which used to be known as economy.com. Moody's bought economy.com. The chief economist there is Mark Zandi. I'm sure you guys have all seen him on CNBC or Bloomberg any number of times. We think they're the best market level forecasters in the US. The other big player in that space is Oxford Economics. Moody's is 2.5 times as expensive, and there's a reason for that. Moody's is better, plain and simple. We use Moody's. A lot of our competitors use Oxford. We think there's a reason we chose Moody's, and it's that it's better data. Citywide pacing data comes from the CVBs. Office market comes from Moody's Analytics. Again, Moody's also owns Reis, which if you're familiar with the commercial real estate space, Reis is a big data provider within the office, retail, industrial space. So they've got great data on the office market. We've got supply data from Build Central. With regards to supply, we've looked at STR, Lodging Econometrics, and Build Central. And Build Central also goes by Hotel Market Data, both brand names. None of them are perfect. They all have their challenges. All the data requires a substantial amount of scrubbing and vetting. We do that. We think Build Central is the best of the three, but they all have their challenges in our view. Short-term rental data or home sharing comes from AirDNA. Historical cap rates comes from Real Capital Analytics. We use RCA's data on a market-wide basis, not for individual transactions. We don't think RCA's data on individual transactions, especially cap rates, is great. But market-wide, when it's aggregating a bunch of different transactions, we're much more comfortable. And then we use our partners, Elliott LW, Dan Lesser publishes a quarterly report on the largest transactions of the quarter. We incorporate that information into our reports, but it does not go into our models. That being said, let's dig into the US market currently. So if you think about where the US has been, US operating fundamentals, have been struggling, obviously, but there's good news. Things seem to be getting better. 2020 was down a horrific 47.5%. No major market was unaffected. But if you look at 1Q 2021, you started to see, hey, not only are most markets starting to improve, Norfolk turned positive in the first quarter on a year-over-year basis with RevPAR growth, and a lot of other markets, especially on this side of the chart, saw a meaningful improvement from 2020 to the first quarter. That's a big positive. Not every market did. San Francisco, Honolulu, New Orleans all saw a worse first quarter than they saw 2020. And I think this gets back to our key point that not every market is going to recover at the same pace. And understanding which markets you want to be in and which ones you don't want to be in, I think are going to be critical to success over the next couple of years for any hotel portfolio, whether you're an operator, an asset manager, an owner, or a brand. And then moving on, as we look at where things have started to improve recently, we're going to talk a little about air traffic and TSA throughput. What this chart here shows is TSA throughput on a 14-day rolling average. And what you can see basically is we've been on a steady upward trajectory, but really the slope of that line started to pick up in early February, where we troughed at about almost 100% down, right? Basically no air travel back in April of 2020. Since then, it's been recovering. And you actually saw from basically early February till the end of May, go from down 60% relative to 2019 levels to down 30% relative to 2019 levels. That's a pretty big jump over 3 months, whereas it took us almost a full year to get that same amount before. And I think that highlights that you started to see a pickup in throughput, which is obviously a positive for travel. If we look at it as it pertains to hotel bookings, this is data from SiteMinder. And I think it's interesting that what you saw February 1, booking volumes were about 55% of 2019 levels. A month later, March 1, 63%. By May 1, 76%. And as of May 31st, 83%. So you've seen a big pickup over the past 3 months. From February 1 to March 31, you went from 55% of 2019 levels to 83% of 2019 levels. That's obviously very positive. Unfortunately, it is very skewed to leisure. And in the chart here, what you see, the dark blue is global and the light blue is the US. So you see the US meaningfully outperforming. Not too surprising. If you look at the chart down here on the bottom right, booking windows are still very short. We expect those booking windows to pick up as the recovery continues, but right now things are relatively short because there's a lot of availability and people don't need to book further out. So what's driving this big improvement, right? You've got improvement in TSA travel, you've got improvement in booking trends, all since basically early February. Well, my guess is you guys all know the answer to that. It's vaccinations, woohoo! The vaccine is here and people are taking it and it's helping. As of May 31, there were approximately 135 million US citizens fully vaccinated. That's a big chunk. What's interesting is if you go back to the first day that a US citizen was fully vaccinated, which was January 19th, and you look at the data through May 31, there is a 76% correlation between vaccination rates and TSA and air travel, TSA throughput. And there is a 58% R squared. Those are very strong numbers in a very short period of time. And that highlights the strength of the relationship that as people are getting vaccinated, they are booking travel and they are traveling. And the good news is the vaccine's continuing to roll out. We're getting more and more people fully vaccinated every day. We generally have the view that any American that wants to be vaccinated will be fully vaccinated by the end of June. Those that don't want to be fully vaccinated obviously won't be. And frankly, they probably won't. It probably won't deter them from traveling if they want to travel, because they've made that choice themselves. Now, while all that is really, really positive and gets us really excited about what's coming, the negative that's important to highlight and to balance is that as of 2 days ago, only 6% of the global population was fully vaccinated. And keep in mind, there are markets in the US that are very domestic oriented where there's not a lot of exposure to international commerce or international inbound tourism. And those markets will recover relatively well. But then there are the markets that are much more exposed to international commerce and international inbound tourism. And those markets are going to take much, much longer to recover. To give you some perspective, 6% of the global population is fully vaccinated today. Most scientists believe that it's going to be somewhere around 60 to 70% of the global population needs to be fully vaccinated to reach herd immunity globally. And for a lot of emerging markets, that's looking like 2023 or later. Now, the good news is the wealthy countries are actually progressing faster. And the wealthy countries are the ones that are more tied to international inbound travel to the US. So that bodes better, but it's still a challenge that major gateway markets are going to have to contend with over the next 12 to 24 months, that some other markets that are more domestic oriented really won't. Moving on, let's talk about supply closures and where things have been. So supply closures peaked in April of 2020, about 800,000 rooms were closed. It's about 14% of the overall US inventory. Shouldn't be too surprising, the concentrations of where that supply was mostly closed. Union labor markets, large resorts, international destinations, theme parks that were closed as a primary demand driver. So you'll get markets like Honolulu, Miami, Orlando, Houston, San Fran, San Diego, New York, Anaheim, et cetera, that were the biggest, as the biggest percentage of their inventory was closed. If you fast forward from April of last year, basically to April of this year, 85% of those 800,000 rooms have reopened. The attributes of the markets with the lowest reopening levels are the same as the ones with the highest percentage closed. And look at what you see here, down over here. You've got New York, San Francisco, Chicago, Anaheim. Anaheim's kind of a unique situation because hotels didn't reopen by March, but then they started to reopen in April and May, tied to Disney and Universal. In April, being allowed to have California residents visit, and come June, all residents anybody will be able to visit Disney and Universal, and that will impact Anaheim pretty meaningfully. So where are we as of the end of March? As of the end of March, 105,000 rooms remained closed, but in April, 37,000 of those reopened. So you're now looking at about 2% of overall inventories are still closed as of the end of April, and they're opening. And the 37,000 was an aggressive reopening in April. Again, we believe tied to the vaccines, tied to some of those major markets like Anaheim that started to see some reopening. And if you look down here and you look at where the closures are, 21% of all the closures across the US are in New York, 10% in Orlando, 10% Chicago. Anaheim's got 5%. We would expect almost all of that 5% to reopen in the second quarter, with Disney and Universal being able to take guests. Same thing with Orlando, with Disney basically ramping back up. So we'll see it in some major markets, but beyond that, things are really reopening pretty quickly. And by the end of the second quarter, virtually all of the US temporarily closed hotels will have reopened. The last thing I want to talk about with regards to supply is the short-term rental market. For those of you that have seen this webinar before, I may sound a little bit like a broken record, but it's amazing how often different factors can come into play. First and foremost is when you look at the short-term rental market share of the short-term rental market has been relatively benign, but growing over the past, call it, sorry about that. Call it over the past 5 years. It's been steadily growing, but other than the pandemic spike, you only saw market share at about 5% at max. So it hasn't been a huge impact yet. It's getting a ton of attention. And that attention is because it is growing, and when you grow from under 1% to 5% over, just less than a decade, it highlights how the strength of the growth profile. But if we look at the growth profile and look at how revenues are growing, first of all, the revenue growth rate has rapidly slowed. This is revenue growth, the light blue line on a rolling 4-quarter average to adjust for any seasonality. It has rapidly slowed. But what's really interesting is if you look at the chart right next to this, this is supply. And this is the supply growth, or the available room nights of short-term rentals across the US. And if you layered those two charts on top of one another, those two lines would look identical. And it highlights how much supply is really driving the short-term rental revenue growth profile. As supply goes and as more inventory comes to market, revenues go up. And as inventory declines or growth slows, revenue growth declines or slows. It's not ADR. As you can see, that growth rate looks very different, and it's not occupancy either. As a result, the regulatory environment has a huge impact on the short-term rental market. So we're in an environment today where some markets have a lot of regulation, other markets don't have any regulation. And understanding what's in that market from a regulatory perspective for the short-term rental market will have a big impact as to whether this is looking like this or whether it's starting to turn the other way and go down. So just something to keep in mind. We certainly track the regulatory environment across every market that we analyze. So let's talk a little about why this cycle will be a little different. So first and foremost, this cycle's recovery timeline compared to past. If you look at the chart here on the right, you'll see the dark blue solid line right here is the current downturn. Not surprising, it's steeper and deeper than anything else. And this is RevPAR on a rolling 12-month average. The light blue dashed is the great financial crisis downturn and recovery. And then the dark blue dashed is the 9/11 downturn and recovery. Obviously, we're steeper and deeper. Not too surprising. The good news is we started to pop back up. Just to give you some perspective, the great financial crisis, it took almost 6 years to recover back to prior peak RevPAR. And after 9/11, it took almost 4.5 years. I'm sorry, 5 years and almost 4.5 years. On an occupancy recovery timeline, it's a little bit slower. It took a little over 80 months to recover to occupancy peaks following the great financial crisis, and following 9/11, it took 65 months. And if occupancy is slower than RevPAR, then ADR is a little faster, right? ADR took 52 months following great financial crisis and 45 months following 9/11. And when you think about values, and this is where things start to get really interesting. Following the great financial crisis, values peaked in 2007. They dropped 27% from 2007 to 2009. And it wasn't until 2015 that asset values recovered back to 2007 levels. That was 8 years later. The good news is that in the following 3 years, values grew by another 18%. So you saw some nice growth. However, if you think about where the last peak was, it was actually 2018 on values. Values declined slightly in 2019, and we estimate that they declined 24% in 2020, bringing this peak to trough about 29%, which is frankly very similar to the 27% we saw here. And we'll get back to why it's only 29% and where it's going from here in a little bit. So why is this recovery going to be different than the last one? Obviously, it fell further. There's no doubt about it. It's fallen steeper and harder, and hopefully there will be a faster recovery. But if you break it down to the three demand segments, group, leisure, and corporate, we're going to see a situation that is primed for success relative to past cycles. So let's talk about citywides and convention business. This is convention booking data for the 30 largest convention centers across the US. And basically what this data shows you is that, not surprisingly, 2020 is down massive from 2019. 2021's up big from 2020, but that's off such a low base, it doesn't really matter that much. What's really interesting is that post Labor Day 2021 is actually pacing back to 2019 levels. And if you look at 2022, 2023, 2024, you're only down like a fraction of what you would have been coming out of past downturns. We think of group and especially big citywide conventions as the last to recover, the slow, battleship of the lodging industry that just doesn't turn around easily. And this is going to turn on a dime, not because new bookings have occurred, but because the bookings didn't just dry up entirely. What happened was they just got pushed out. So the cancellations from 2020 moved into 21, and cancellations from 2021 moved into 22 and 2023. And as a result, you've had this opportunity to recoup a lot of that demand very, very quickly, as opposed to it just eroding away. Another example, Ryman Hotels, I think on Friday, just published an update to where their booking patterns are. And similar to this, they're suggesting that their group booking rates are on par with 2019 levels in the back half of this year, and actually up in 2022 and 2023, if I'm correct. So I think that points to the similar story here, that group is coming back much faster than we've seen historically, period. Now, let's talk about leisure. We're all excited about the summer leisure season, right? Summer leisure season looks really strong. We just showed you how the booking volumes have really picked up, how TSA throughput's really growing. What's driving all that? The best answer I can give you is two things. One, there's an incredible amount of pent-up demand from people being trapped at home and not traveling for the past year and a half. And two is the gross savings rate, which is a great indicator for leisure demand. Gross savings rate is at an all-time high. It ended 2020 at 4.2 trillion. 2020 was the only year where there was a recession, and the gross savings rate ended the year higher than when it started. We can thank fiscal stimulus for that. We can also thank the fact that people generally kept their jobs and were staying at home. So there's some interesting dynamics there that point to relatively positive leisure travel. People have the money to spend. And to give you some perspective, like I said, the gross savings rate increased 3% in 2020. During the great financial crisis, it dropped 11%. And during the 9/11 downturn, it dropped 5%. Our savings rate is now 2 times what it was coming out of the great financial crisis. Leisure is coming back strong this summer. This is going to be the best summer we've ever seen from a leisure demand perspective, in my opinion. And that's what the data tells us. And we think that's going to help. Leisure will moderate after the summer, but leisure is still going to be pretty active as we move forward. And that's going to be a big positive for the hotel industry. And the last segment, corporate, we'll talk about. The thing to think about with corporate is that, a lot of times when we're so focused on the hotel industry, we get bogged down, and 2020 was such a tough year. Revenues were down so much, NOIs were negative, couldn't cover debt service, all these challenges that the hotel industry faced. Guess what? Not every industry looked like that. The hotel industry saw revenues down 27% over the course of 2020. According to sector data. So that's more than the hotel industry, it's leisure and hospitality in general, down 27%. IT was actually up 4%. Financial services were positive. Professional business services were only down 2%. And if you think about it from that perspective, the perspective of the primary sectors that drive hotel demand, especially on the corporate side, the corporate transient demand, which are IT, financial services, professional and business services. Those sectors in aggregate actually didn't experience a recession in 2020. They had their revenues increase from year over year. And when revenues are increasing and the stock market's at all-time highs, it was up 15% in 2020 and up another 14% year to date when I checked this morning, you're looking at a situation where you are poised. These companies aren't looking to cut costs. Then there isn't this pressure. We have to cut costs. It's all about growth, and growth is being driven by revenues. And how do you drive revenues? You sell more, you get out, you meet with your clients, you meet with prospective clients, you engage, and that's going to fuel more conference business and conventions, as well as more corporate transient. And to give you some perspective, how does that compare to the last couple of cycles? Well, like I said, we're up 29% in the stock market from 2019 and year-to-date 2020. The S&P from peak to trough during the great financial crisis dropped 27%. And 9/11, it dropped 40%. This is a huge shift. And we think that's going to create basically a rubber band effect where things are going to snap back very aggressively on the corporate side. Though we don't think it really happens until people come back into their offices, which we think is we think is going to be very limited this summer. So it's really much more of a post Labor Day story. We think the summer is driven by leisure, and then after Labor Day, you're going to see all three segments driving the recovery in a pretty meaningful way. And then the last thing that I didn't even get to talk about yet, which is different from past cycles, is let's talk about fiscal stimulus. We've got 4.8 trillion in fiscal stimulus that's been passed today. That's 25% of the pre-pandemic GDP. Compare that to after the great financial crisis, where we had less than 1 trillion, and that was about 6% of the pre-financial crisis GDP. We're talking 4 times as much. And we haven't even talked about the infrastructure bill. Moody's Analytics is expecting the infrastructure bill to move forward with about 3 trillion in additional fiscal stimulus. Now that will get passed later this year in our assumptions, but it's going to take several years for that to play out. So we're looking at a total of 7.8 trillion in fiscal stimulus, or 41% of 2019 GDP. Massive, massive numbers. Now there's good and bad. The good is that, that's going to fuel a lot of growth in the near term. There's going to be a lot of money in the market. And it's going to drive a lot of demand, and it's going to be good for hotels. The bad is we're basically just pulling growth forward into the near term from the longer term. So the long-term future is paying dividends for the short-term future. But that's good for the short term, which is worth highlighting right now. All right, so let's put all that together into our US outlook. So a couple of things that we would highlight, which we think are important as you think about our US outlook. Number one is we think we're moving past COVID for the most part. Obviously, we talked about the fact that there are going to be certain markets that are much more challenged than others, but we expect infections to abate by the end of June across the US. Things will be relatively benign. Which will be good. It's not going to stop people anymore. Infections peaked in early 2021. We're not going to see a resurrection of that. As I mentioned, we are assuming 3 trillion in the Build Back Better agenda from President Biden. That's going to be gradual, not right away in 2021, though we think it will get passed. It will be several years of infrastructure spend and social programs. And then inflation, which obviously is a hot topic, will spike spike this quarter at 3.2%. Will be up close to 3% this year, and then moderate close to 2% in the years that follow. We're not looking at, our assumptions don't include some type of hyperinflation or massive elevated inflation over the longer term. And then the other thing that is worth highlighting is BAA bond yields are going to rise over 100 basis points this year, and they'll actually get to 6% level by 2024. To give you some perspective, 6% hasn't been achieved since 2011. So we're looking at base rates moving materially higher over the next few years. Let's talk about supply here. Our supply outlook has moderated a little bit for 2021 and increased a little bit for 2022. And that's really just driven by the timing of openings related to the delays that have occurred over the past 12 months. There's been a ton of delays related to new openings. Our general assumption is that properties that were under construction in 2020, going into 2020, will eventually open. The question is the length of the delay, and the delay was initially impacted by a lack of construction labor, followed by supply pipelines, followed by lack of government resources to do the appropriate inspections to get you open, and then lastly, owners that went through all of those hurdles and then just delayed the opening until we're starting to see demand come back. So all of those factors have pushed our openings from early 2021 into really 2Q, 3Q, 4Q of 2021. And as a result, our supply growth number comes down a little bit for 2021 on an economic basis, which adjusts for the temporary closures. We're at 1.4% this year, but then we jump up to 2.2% in 2022, not because we've got more projects in the pipeline than we had before, just because the dates of the opening are going to impact those first couple of quarters of 2022 more than we had expected before, and those last couple of quarters as well. And then things really dry up thereafter. Ultimately, we've got a 5-year outlook for economic supply growth that's relatively benign, below long-run averages, under 2%. And we feel pretty good about that. The other thing that I would tell you when it comes to supply growth is We generally assume that all hotels were temporarily closed will reopen by the end of the third quarter. There are a handful of exceptions to that. Those exceptions are primarily in New York and California. In California, you've got a handful of hotels that have been acquired by local municipalities for conversion to homeless shelters. Those hotels we think will be gone. The second aspect with New York is that we think there will be some hotels that are permanently closed. Most of the hotels that are permanently closed will be permanently closed because they should have been permanently closed decades ago. The Hotel Pennsylvania and the Roosevelt are great examples of that, where they're hotels that when Vornado bought the Hotel Pennsylvania in '97, they planned to tear it down. If you go back to pre-Great Financial Crisis, Vornado was going to tear it down and build a headquarters for Merrill Lynch before Merrill Lynch ended up getting acquired by Bank of America. The Roosevelt has been another property where it's been rumored to be torn down for an office building development for the past decade. Or longer, 2 decades. Those are 2 properties that we think go away. Obviously, the Grand Hyatt, you're seeing a massive reduction in the room count and with the condominium conversions there. But ultimately, those 3 hotels account for 3,500 of the roughly 4,500 rooms that we expect to be permanently closed across New York. We don't think you're going to see 20,000 rooms closed across New York permanently. We think hotels will reopen. Moving on to our models. So this is our RevPAR model. The dark blue line that you see in this chart is STR's actual RevPAR on a seasonally adjusted basis, as reported by STR. That's actual data. The light blue line is our model for RevPAR. You can see its accuracy going back to 2000, and then what it's forecasting going forward. For those of you that understand statistics, it's got a 99.7% R squared. Which for those that don't understand statistics, that basically says it predicts 99.7% of the variability of RevPAR, the volatility of RevPAR. So highly accurate. And you can see the major drivers of our model. These aren't all the drivers of our model, but it's most of them. Unemployment rate, real GDP, S&P 500 index, exchange rates, and then supply are the big drivers for our RevPAR model. Our ADR model, again, should look pretty similar to that last slide. Here, the dark blue line again is STR's actual ADR on a seasonally adjusted basis. Light blue line is our model. You can see how well it has historically forecasted downturns and recoveries and where we are here. This has a 98.6% R squared. The variables are different. Business investment, inflation, consumer confidence, and unemployment rate are the primary drivers of our ADR model. We put our ADR and RevPAR models together to build out our occupancy outlook, occupancy and supply to build out our demand outlook. And that gives us our top line metrics. Then we work on the bottom line. And if you look at the bottom line, I think the couple line items I really want to talk about are property taxes and wages. Property taxes, we forecast a 4.5% property tax CAGR over the next 5 years. That is about a point lower than where we were 3 months ago. The real driver of that shift is the American Rescue Plan. That was passed in March. The American Rescue Plan is contributing $600 billion in funding to municipalities across the country. And what that's doing is it's providing a lifeline and a short-term reprieve for all those cities that are underfunded and can't balance their budgets. That's good news in the near term. It doesn't solve the problem in the long term. We need to see budgets get balanced. And typically the way cities balance budgets isn't by slashing expenses as much as by raising taxes. We expect property taxes to continue their upward trajectory regardless of where market values are. This is all tied to what cities have to fund. And so we've moderated it a little bit. That 4.5% CAGR is weighted to years 3, 4, and 5 as opposed to years 1 and 2, but it is meaningful. With regards to wages, one of the things that we have learned with regards to wages, and we hear a lot in the press related to wages, and people are talking a lot about wages, and it's very real, but it is very different market by market. Some markets are doing fine from a wage growth perspective. Other markets are facing massive, massive challenges. We generally expect wages to be up in the second quarter materially more than they were the prior couple of quarters, where we're looking at 3% wage growth in 2Q 2021 versus roughly flat in 2021 and 1Q 2021 and slightly positive in 4Q 2020. But we expect that to roll over a little bit in the third quarter, largely tied to underemployment and unemployment benefits rolling off and more people entering the labor force to get back to work. We put all that together and we get to our overall EBITDA growth outlook, which basically highlights that we forecast hotel EBITDA to recover to 2019 levels by 2023. And it'll be 10% above in 2024 before taking a step back in 2025. And that's largely tied to our economic views for 2025, which are more modest, where RevPAR growth meaningfully slows. With EBITDA, we then build out our cap rate models. So this is similar to our prior multivariable linear regression forecast. You'll see our cap rate model. Dark blue line is the actual cap rates from Real Capital Analytics. Light blue line is our model. You can see the cap rates crater tied to the declining cash flows and then recover back basically to where they were pre-pandemic levels, about 5 basis points above where they were pre-pandemic levels. That's a 98.2% R squared. You can see the major drivers here. What's important that I highlight is BAA bond yields are a major driver of our cap rate model. Other things that wouldn't be included here that are worth mentioning is overall capital raised for real estate investments, distressed funds. All those things have a big impact as well on hotel cap rates. And that's one of the reasons why we are optimistic in terms of values over the longer term, despite the fact that base rates are going up as high as they are. So key takeaways with regards to our forecast. We forecast ADR and values to recover from all the way back to 2019 levels by the end of next year. RevPAR and hotel EBITDA a year later, 2023, and then occupancy 2024. The key changes relative to our March outlook, I talked about supply earlier. We've gotten a little bit more bullish. Their economic growth outlook has really picked up, as we mentioned. So demand's higher, occupancy's higher, ADR is more positive, RevPAR is more positive, and that's driving EBITDA higher for 2021, but values are down, again, tied to base rates moving higher, like I talked about. So down relative to our March forecast. Now, if we go back to that recovery timeline for values that we looked at before, and we look at, well, let's layer on our outlook for it. So the dashed line here is the current cycle. The solid blue line is the Great Financial Crisis downturn. Like I said, from peak to trough, the Great Financial Crisis dropped about 27%, and we're suggesting that during this downturn, we dropped about 29%. We don't have a ton of growth this year tied to values, but then they really spike really fast and really, really strong. And you actually get back to 2019 levels super fast. Right? We talked about 2019 levels getting back by 2022, and you get back to prior peak, which was 2018 levels by 2023. So that's 5 years. I remember we talked about it being 8 years last cycle. We're talking 3 years faster than the last cycle that you recover. And then again, we have a little bit of a pullback tied to EBITDA declining, which was tied to slowing economic growth. Again, we're pulling economic growth from the future to the present by with all the fiscal stimulus. So if we look at that recovery timeline, in general, we expect things to be much faster this cycle, right? If you look at where we are from an occupancy perspective, you're going to see occupancy about 1.5 years faster than the Great Financial Crisis recover back to prior peak, only a couple of months faster than 9/11. But again, the occupancy hole is much deeper here. From an ADR perspective, about 3/4 faster than 9/11 and about 1.5 years faster than the Great Financial Crisis. And RevPAR about half a year faster than 9/11 and a little over a year faster than RevPAR than the Great Financial Crisis, and then values 3 years faster than the Great Financial Crisis, much faster, which we think is very positive. So just want to talk a little bit about kind of all the forecasts out there and what's going on. At the end of the day, the economic outlook is constantly changing and constantly moving. If you look at these are the last publicly available forecasts that I've seen from all the major providers, from STR, PwC, CBRE, and LARC. CBRE, it's March 30th. There may be a more current one than that. I am not sure. I have not seen anything more current than that, but perhaps clients have. But regardless, what you see is basically there is a big disparity, especially to 2021, between those that are those that have forecasted more recently and those that have forecasted later. PwC and LARC are materially positive, and then CBRE. STR is positive for 2021, but much more conservative in 2022. We remain particularly positive in 2022 as well, and then 2023, as we've got ADR and RevPAR recovering at least a year faster than CBRE and STR. So just worth highlighting that we're a lot more bullish, not just in 2021, but 2022 and 2023. It's not until 2025 that our numbers start to get more in line with where the only other prognosticator out there is at CBRE. So market highlights, let's talk about some major markets. So I'm going to focus on the top 26 markets here. We do work on a lot of other markets. If you're interested in another market, let us know. We probably work on it. We probably do it. It's been a busy 6 months or so as we've been doing work across all size, shapes, submarkets, you name it. But we're going to focus on the top 26 here, which is STR's top 25 plus Las Vegas. These are our R-squareds for all of our models for RevPAR, ADR, and cap rates for those 26 markets. You can see they're all over 90%. So our clients should have some confidence that they're relatively similar to our views on the U.S. You know, our models are trustworthy. So top performers for 2021. Norfolk, Tampa, Miami, Phoenix, and Houston stand out. Norfolk and Tampa are a little bit more unique. They're the runaway winners for 2021. And this is all relative to 2019, mind you. We're not trying to look at it on a year-over-year basis because the deeper the fall in 2020, sometimes the faster the rise in 2021. So relative to 2019, Norfolk's almost already back to 2020 to 2019 levels. And that's just driven by the fact that it is such a domestic leisure market. We did a lot of work for another domestic leisure market, Myrtle Beach, and Myrtle Beach also is crushing it relative to a lot of the major markets. These domestic leisure markets are doing very well. Tampa is also a heavily domestic leisure market, believe it or not. It's, you know, it only has about 5% of its air traffic is on international flights. And those two markets stand out as the primary winners. They're the strong ones. Miami is also very strong, but Miami also has international exposure, cruise line exposure, which basically puts it in a tier below Tampa and Norfolk, though still very strong. And then Phoenix and Houston, it's just very resilient economic activity has really supported those markets to be outperformers. The bottom performers shouldn't be too surprising. New York, Boston, San Francisco, Chicago, all of the same story. Fly to, high density, international orientation. New Orleans is a little different. New Orleans is underperformed because of the strong seasonality in the first quarter. First quarter was obviously really weak in 2021 because of the pandemic. So they don't get the benefit of the recovery that you're seeing over the summer in New Orleans. So that leads them further down this list. That coupled with outsized group exposure, and group is a little slower to recover, especially during the first 8 months of the year. So New Orleans ends up being an underperformer as well. Now, looking out beyond the next year or so, let's look out longer term to markets that we really like. And these are our top 5 markets for investment today for the next 5 years. Denver, Phoenix, Tampa, LA, and Las Vegas. Denver and Phoenix, I'm going to group together. These are just high growth markets. Strong economic growth, net migration is very positive, economic activity is strong, expense growth is modest. You've got solid EBITDA, cap rates that are reasonable. All of that is going to lead to values that are going to appreciate. We forecast values that are up 13% from 2019 levels by 2025. Tampa is another really good market, one of our favorites. Solid economic growth. Supply growth isn't crazy across that market. You've got good domestic leisure demand, which is going to help in the near term. Overall, we estimate Tampa's 2025 RevPAR is going to be 15% above 2019 levels, and EBITDA will be 13% above. Again, modest costs as well. All that's very positive, leading to values that are 11% above 2019 levels. Los Angeles is a little bit different. Los Angeles is probably the one market where it shows up here as a favorite for hotel values, but not here. And in terms of RevPAR growth, it's actually further down. And one of the reasons for why it's here, but not here, but there, is that we're actually very bullish on Los Angeles ADR growth. And that's tied to a couple of different things. One, there's a few major events that we think are going to spike ADR pricing and pricing power. You've got the Super Bowl, you've got the College Football Championship, you've got the Olympics coming not too far down the road. And then the other thing is you've got a massive amount of high-end product going up in downtown LA that we think is going to help fuel pricing power across the market, which is going to lead ADRs higher in general. So we're pretty positive in terms of ADR, which is really driving EBITDA growth. So we're relatively positive on EBITDA as a result, and that's driving values up 11% in 2025 versus 2019 levels. And then lastly, Las Vegas. This is a leisure orientation story coupled with really strong economic growth. It's a good recipe for the short term and the long term, which is ultimately going to lead Vegas to be an outperformer with values up 10% over the next 5 years. Now, the last slide that I want to highlight here is the markets that over the past 3 months we've gotten a little bit more bullish on, and those that we've gotten a little bit more bearish on. So the ones that we've gotten more bullish on include Miami, Anaheim, and Vegas. Miami, this is real simple. Performance has been better than we expected. The market has been much more resilient to the dearth of international inbound arrivals and the lack of the cruise industry than we had expected. We've adjusted our numbers to account for that, and it makes Miami a better market than we had forecasted before. Still not bullish on Miami, just not nearly as negative as we were. Anaheim, this is tied to the reopening story of Disneyland and Universal. We always knew Disneyland and Universal were going to reopen. We just didn't know when. When we released our early March forecast, there was talk of Disneyland and Universal opening mid-April for California only. Not only did it open in mid-April for California, but now they're opening for anybody, not just California residents, starting in June, and that's gonna increase demand to the broader market. It's giving us generally a more positive view of the Anaheim market sooner than we had expected. And then lastly, Las Vegas. This is just strengthening consumer confidence, fiscal stimulus. All this is really positive for Vegas, which has now entered our top 5 for markets for investment. Markets that we've gotten a little bit more cautious on: Boston and New York. Boston, we're still positive on Boston. We're almost as positive on Boston as we are on Vegas right now. We've just mellowed our approach a little bit. At the end of the day, it's really driven by our Boston story has been largely driven by cap rate compression. We think cap rate compression is going to continue to occur, just not to the same extent we had forecast before. And that's largely driven by the changing views on BAA base rates. And then New York, this is just low economic growth, high expense growth, modest reductions to our top line and bottom line outlooks. It has such a big impact on values when you're already priced to perfection at a low cap rate. So with EBITDA coming down, we generally forecast New York being a little bit more challenged than we had forecast before. Now, New York's an interesting story because what's going to happen a couple years down the road is there's effectively a supply moratorium coming on in New York, where you're just not going to see any new development across all 5 boroughs. And when that happens, I think it'll be a pretty big positive for New York that will ultimately allow New York to absorb the supply as international demand comes back and you get more leisure travel, more international commerce, financial services do well. So there will be a time for investment in New York. We're not sure it's now. Obviously, you find a great deal, awesome, but we'd prefer to wait 12 to 18 months before we started looking at New York. Okay. And then the only thing I'll add, I'm just going to go over this real quickly. Our market reports, our single reports typically cost $2,000. Single markets for an annual subscription are $3,000. For the whole platform, top 26 markets, it's almost $30,000. We're constantly providing promotions. We're constantly offering discounts for those that purchase more than one market. So if there's something that you're interested in, you want to know the pricing, just reach out and let us know. You can reach out here at information@larkanalytics.com, or to me directly if you Ryan.Melliker@larkanalytics.com. With that in mind, I'm going to go ahead and take any questions. If there are any questions at the moment, I don't see any questions in the queue. I know somebody had tried to raise their hand earlier, but that doesn't help, unfortunately, because I need to see the question in the queue. So I'll give you guys a minute if you want to load any questions in the queue. Feel free. If not, and you want to hop off, go ahead. Just again, please complete that 30-second survey. Thanks so much. Steve, if you're there, I got you with a question. I guess not. Okay, we've got a question here. Should inflation occur as you suggested? Shouldn't cap rates increase versus maintaining? I think the short answer is yes, cap rates will move higher. We do have cap rates moving higher from current levels. I think there's a lot of factors that impact cap rates. Inflation is one, base rates are one. Usually those two are going to move together. There's also the amount of capital chasing deals, growing cash flows across the hotels. If you look at where we are today in terms of cap rates versus where we're going in 2025, our cap rates increase pretty dramatically. From where we are, but we think they compressed pretty dramatically tied to the falling cash flows. If you look at it back to 2019, I would argue that the comparison from 2019 to 2025, inflation will be a little bit higher, but it won't be that high. We're looking at 2% inflation, looking out beyond this year. So that's not very elevated. Base rates will be a lot higher, which will have an impact, but you've also got a stronger economic activity, which should offset that, coupled with other factors that really drive value and a lack of supply, which should be pretty positive. Thanks. Another question I've got, are you hearing that hotels are capping occupancies weekday, weekend, and driving ADR due to labor challenges? We're absolutely hearing that here and there. A lot of that is in more leisure-oriented markets where you can cap occupancies and you have enough demand, you're driving ADR, you don't have the labor. That is 100% accurate. We are hearing that. And look, I can give you an example. There was one leisure market I looked at where April ADR was 17% above 2019 levels. Occupancy wasn't. And I think that's a prime example of that type of situation. So another question I've got is, how's the wage rate CAGR of 2.9% derived? Do you view this as conservative or could there be risk? So I think the short answer is that is derived by Moody's Analytics, our economists. They actually forecast wage growth rates across the hotel industry by market. So they provided that. And if I go back to that slide, which I've got right, not this one, there it is. What you'll see, this is the actual quarterly wage growth rate. So 2021 is actually low. It's going to pick up in 2023, but these couple of years are relatively modest, tied to the high unemployment rates in 2021 and 2022. But 2Q obviously spiked because people weren't willing to come back to work yet while hotels started to hire. The other thing I would caveat with this data is this is tied to actual wages. If you build in any retention bonuses or sign-on bonuses, it wouldn't get factored in here. So maybe these numbers are a little light relative to what you might be experiencing in a real-time basis. All right, I think that is it for the questions. I'm going to go ahead and stop my share. I just want to thank you all for joining. I hope you found it helpful. And if LARC can be of any help to you going forward, please don't hesitate to reach out. Thanks a lot and have a great day.